I'll be going through with you Oak stock. Type it in Google and please enter, and then you can see information just from Google. You can see the name here. You can see the stock symbol. If I want to buy right now, to pay 50.72 US dollars for one stock. It's a billion size firm. It's a big firm. It pays dividend. Any firm that is paying dividend, that means they're financially very strong because after paying their liabilities, loans, creditors, they still have extra money left. That extra money pays to shareholders as dividends, and even if it's less than 1%, that's brilliant news. That's a positive sign because that means they have extra money. And don't worry about like if it's paying 6% or 5% or 1%. Even if it's less than 1%, they are still showing you that they're financially strong because that's extra money of the firm. So let's go to Wikipedia and see when was this founded. I can see this box here easily. I can see founded 1995, 24 years ago. Now I want to see that. I just want to see what the employees who work there think about this firm. So I'll just copy this exactly and then type in reviews, and I can see that we have 22 reviews, 3.8 star. Check out the salaries, the job listed, the question answers, and check out what people have to say about it. And I want to see the reviews in Glassdoor as well. And let's have a look. You can see the reviews, 75 reviews, 3.7 star. Read through the reviews yourself, the salaries, the jobs listed, the interview questions, the benefits they're getting, and the photos. Check out the patents, industrial patents. I'll just paste it here, and I can see they have no patents. If a company has patent, that means they are very strong. It's difficult to beat that firm, but I can see that this firm has no patents. So let's look at the Yahoo Finance and see that what key executives are getting as salaries. So I'll just type in the I'll type in the symbol oak, and I'll just go to profile. Okay, check out the sector, industry employees, and I can see that we have 5 key executives. All of their salaries have been shown. That's brilliant because it's very transparent in terms of salaries. So that's brilliant because that we can build trust with this firm. So they have shown us all the salaries. That's good. Now let's go to macro trend, and I want to see the ratios. Click price ratio, price book ratio. Type in the symbol oak and click that. If price book ratio is less than 1, that means stock is cheap. It's at discount. It's a sale. If it's less than 1, if it's more than 1, that means stock is expensive. The higher the number goes, the more expensive it gets. So right now I can see it's 3.25. So it means stock is 3.25 times more expensive right now. In 2019 March, it's 3.18. It means people who bought that time, they paid 3 times more money. So they bought it for $49. They paid $49 to buy something that was $15 worth. You can see just vertically up, and right now it's 3.25 times more expensive. And the cheapest it was in 2018 December when it was 2.47 times expensive. So people bought it for $39. They paid $39 to buy something that was $15 worth. And I think it was the most expensive in 2014 March when it was 3.7 times more expensive. People paid $43 to buy something that was $11 worth. Right now it's 3.25 times expensive. Let's go to other ratios and check out current ratio. If the current ratio is less than 1, that means stock is risky because liabilities are more than assets. If the current ratio is 1.5 or more than that, that means stock is safe. It has a good margin of safety. Right now, it's more than 1.5. That means stock is very safe right now. Let's look at the previous trends. Has it ever been below 1.5? That's my question. So I can see that we have data from 2011 December up till now. So I can see consistently it has been above 1.5. So it's a consistently it is a safe stock consistently since 2011. That's brilliant. It has a very good margin of safety. It has always been above 1.5. Let's go to debt equity ratio. This ratio will tell me if the company is mainly operating on debt or equity. I'm looking for 0.5 or less than that for it to be very brilliant. Let's have a look. Right now, it's more than 0.5. It's a lot more than 0.5, so it means it's a very risky stock. The debt is, if you see vertically up, debt is a lot more than equity. So it's operating mainly on debt. That's very dangerous. Let's look at the previous trend. Has it ever been below zero point 0.5? That's my question. No. Since 2011 December up to now, it has never been below zero point 0.5. So it's a very risky stock in terms of debt. It is operating mainly on debt, which is not a good sign. Let's go to return on equity. I'm looking for 8% or more than that for it to be brilliant. Let's have a look. So I can see that it's more than 8%. That's brilliant. Return. Let's look at the previous trend. Has it ever been below 8%? Yes, it has. So there are fluctuations, I would say, and I can see that since 2011 December up till um, I would say that up till 2014 September, it's consistently more than 8%. And then it reduced a little bit in 2014 December, even though it's a positive return on equity, but still it's less than 8% for a while. And for a while it's less than 8%. And then it's back to what we want. It's more than 8% in 2016. And then, there are fluctuations, I guess, but currently it's more than 8%, but there are fluctuations. It's ups and downs, more than 8%, less than 8%. But overall it's a positive equity, but it's up to you to decide.